Interest on drawings, discussed about interest on capital. We also discussed about interest on loans and advances. We also discussed about salary, remuneration, commission payable to a partner. Yes? Write down next. Right. How to share profits or losses. Next point. How to share profits or losses. We have learned how to deal with drawings, interest on drawings. We have learned how to deal with interest on capital. We learned how to deal with interest on loans and advances given by the partners. We also learned how to deal with salary, remuneration, commission payable to a partner. So now how to deal with profits, how to share those profits, that is what we are going to discuss now. So please tell me, how should the partnership firm share the profits among the partners, or how will the partners share the profits of the firm? As per the ratio given in the deed. If the partnership deed is silent, then the Partnership Act provides partners have to share the profits equally. If there are two partners, they will share in the ratio of 50 and 50. If there are three partners, in the ratio of 33.33, 33.33 and 33.33. So, if the partnership deed provides the ratio, the profits have to be shared in that ratio. If the partnership deed is silent, then profits have to be shared equally among the partners. Now, what about losses? Losses also have to be shared in the ratio which is given in the partnership deed. If the partnership deed is silent, then losses will also be shared equally among the partners. Okay, so write down. Profits or losses. Profits or losses shall be shared. Profits or losses shall be shared among the partners. Among the partners in the ratio provided in the partnership deed. In the ratio provided in the partnership deed. Comma. If the partnership deed is silent, profits or losses will be shared equally. Profits or losses shall be shared equally. Profits or losses shall be shared equally among the partners. Entries. Entry number 1. Only one entry will be there. When profits are shared, entry will be P&L appropriation account debtor, profit and loss appropriation account debtor, profit and loss appropriation account debtor to partners capital account credit. P&L appropriation account debtor to partners capital account credit. So partners capital account should be credited. Below that you write in the agreed profit sharing ratio. In the agreed profit sharing ratio. Next, one more entry can be there. If there are losses, if there are losses, what will you do? Losses have to be shared among all the partners in the agreed ratio. Okay. What is the entry will pass? Partners capital account return to P&L appropriation account. Partners capital account return to Partners capital account return to P&L appropriation account credit. Below this entry, what will you write? Losses will be shared in there, in the agreed ratio. Losses will be shared in the agreed ratio. Okay. Now one more topic we can discuss is, sometimes a partner may be guaranteed some profits. Sometimes by agreement the partnership deed will provide that a particular partner will get guaranteed profits. Now what is guaranteed profit? I will give you an example. Suppose there are three partners, partner A, partner B and partner C. So when partner C was admitted into the firm, he was admitted on a condition that C should get minimum 50,000 rupees as share of profit. So C entered the firm on the condition that every year C should get minimum, not maximum, minimum 50,000 rupees of profit. So every year he wants 50,000 rupees to be credited to his capital account. Now, after C entered, after a year, at the end of the year when profits were calculated, suppose all the partners were sharing profits equally, A, B, C. The total profits were only 1,20,000. Guaranteed to C. How much was guaranteed to C? 50,000. Okay. At the end of the year, total profits came to only 1,20,000. The partners are going to share profits equally, A, B and C. So A's share will be only 40,000, B's share will be 40,000 and C's share will be 40,000 rupees only. Yes, because they are sharing profits equally. But what was the condition when C was admitted into the firm? He should get minimum 50,000 share, not maximum. So he wants minimum 50,000, but when the profits are shared, he is getting only 40,000. Is there a shortfall? Yes. There is a shortfall of how much? 10,000. Now, this shortfall has to be made good. This shortfall has to be made good by A and B. A and B have to compensate C. A and B have to fill up the pockets of C. There is a shortfall, no? 10,000 rupees. So C will ask A and B, give me the shortfall. You have guaranteed me 50,000, but actually I got only 40,000. So what about that shortfall, 10,000? He will ask A and B about that. So now this shortfall of 10,000, how will A and B contribute among themselves? Now A and B will start fighting among themselves. A will say, B, you give everything, give the entire amount to C. B will say, no, I am a very poor person, you are a very rich man, give the 10,000 to C. So to avoid this confusion, the partnership deed will provide how the other partners are going to meet that shortfall. If the partnership deed talks how the other partners are going to meet the shortfall, so according to the agreed ratio, A and B have to contribute that 10,000 to C. If there is an agreement, if there is no agreement, A and B in their profit sharing ratio, they have to compensate C. Are you able to understand? Write down that also. How to deal with a partner with guaranteed profits. How to deal with a partner with guaranteed profits. Underline. When a partner is guaranteed minimum profits, when a partner is guaranteed minimum profits, by the partnership deed, when a partner is guaranteed minimum profits by the partnership deed, and there is a shortfall, and there is a shortfall, and there is a shortfall, such shortfall should be met by the other partners, as per agreed ratio. If the partnership deed talks how the other partners have to meet this shortfall, in which ratio they have to meet the shortfall, as per the deed. The partnership deed is silent, how the other partners are going to compensate, then in their profit sharing ratio, right off, as per the agreed ratio, or when there is no agreement, in the ratio of their profits. If there is no agreement in the ratio of their profits. The ratio of profits means in their profit sharing ratio. Is it clear? This is about guaranteed profits. So with this we finish the fundamentals of partnership account. Wait, before we complete it, we have to discuss methods of maintaining capital account. Okay. So before we discuss methods of maintaining capital accounts, you help me to first of all prepare the capital account of a partner. Okay. Because now you are students of fundamentals of accounting, you already know fundamental transactions which take place and how to account for it. Partner's capital account. Please tell me, opening balance of capital. Where do you show opening balance of capital? Hemnesh. Opening balance in partner's capital account. Opening balance in capital account, where do you show? By balance brought down. This is your opening balance. The partner introduces further capital into the business. What is the entry you pass when the partner introduces further capital into the business? Cash or bank account debtor to partner's capital account. Yes? So right here, by cash or bank. FC means not football club. Further capital. Okay. Now, partner withdraws money from the firm. Draws money from the firm. What is the entry you write? Drawings account debtor to cash account. Drawings account or to bank account. How will you close drawings account? Drawings account is closed by debiting into the partner's capital account. So we show drawings on the debit side. Next. Yesterday we learned about interest on drawings. Interest on drawings is income for the firm. It is a loss for the partner. What is entry we pass? Partner's capital account debtor to interest on drawings. First entry. Then interest on drawings account is debited and P&L appropriation account is credited. What's the first entry? Partner's capital account debtor to interest on drawings. Interest on drawings account debtor to profit and loss appropriation account. So again partner's capital account is going to be debited. Are you following? So right here, to interest on drawings. Okay. Then sometimes the partnership deed may allow partners interest on capital. interest on capital, loss for the firm, but capital of the partner will increase. Because of interest on capital, partner's capital account balance is going to increase. What is the entry we pass for interest on capital? Interest on capital account debtor to partner's capital account. What is the entry we pass? Interest on capital account debtor to partner's capital account. So partner's capital account is credited by interest on capital. Okay. Now, sometimes partner gets salary, remuneration, commission. What is the entry we pass for that? Salary, remuneration, commission expense for the firm. It has to be credited to whom? Partner's capital account. What is the entry you write? Salary, remuneration, commission account debtor to partner's capital account. So write here by salary, remuneration, etc. Okay. Now, when a partner gets share in profits, just now you have learned, when a partner gets share in profits, what is the entry you write? P&L appropriation account debtor to partner's capital account. When there is a loss, partner's capital account debtor to P&L appropriation account. So when there is a profit, by P&L appropriation account. Share in profits. If there is a loss, to P&L appropriation account. When there is a loss. Okay. So now, what will you get? Closing balance. To balance carried down. This is the closing balance of capital. This was opening balance. This is closing balance. Okay. Now, this method of preparing the capital account is called as fluctuating method. You have prepared the partner's capital account now? No. Yes. This method of preparing the partner's capital account is called as what method? Fluctuating capital method. Why fluctuating capital method? See, as soon as you put an entry, see, so many entries are hitting the capital account, no? Opening balance, further capital, interest on capital, share in profits, salary, remuneration, commission, etc. Drawings, interest on drawings, losses. So many entries are hitting the account. That means whenever you pass an entry, the account balance will either increase or decrease. You pass another entry, balance will increase or decrease. So balance keeps on fluctuating during the year. The balance will not remain constant throughout the year. Hence this method of preparing the partner's capital account is called as what method? Fluctuating capital method. Are you able to understand? This is called as the fluctuating method of preparing the partner's capital account. Now what is fixed capital method then? Somebody's phone is ringing. So what is the fixed method of maintaining the capital account? Can you tell me? Now, did you understand? See, in this, you have opening balance and you have so many other transactions which are affecting the capital account, because of which balance keeps on increasing and decreasing. That is why we call this method as fluctuating capital method. Only one account is maintained. There is another method I told you yesterday. There are two systems. What are the two systems? One, fluctuating capital method, and the second one is fixed capital method. Under fixed capital method, all these adjustments, I have not drawn here. I leave this. All these adjustments, drawings, interest on drawings, losses, interest on capital, salary, remuneration, profits, all these other adjustments are shown in a separate account called as the partner's current account. What is called as? Partner's current account. So under fixed capital method, we are going to maintain two accounts for each partner. Partner's capital account and partner's current account. We are going to maintain how many accounts? We are going to maintain two accounts. Partner's capital account and partner's current account. So if you maintain two accounts, these adjustments, interest on capital, salary, remuneration, share in profits, drawings, interest on drawings, and P&L appropriation account, they are shifted, or they are, we can say, dumped into another account called as the partner's current account. In capital account, you will only have opening balance, further capital introduced during the year, if any. If capital is withdrawn, that will be shown, not drawings against profits. If the partners are withdrawing money from the business in anticipation of profits, those drawings will not be shown in the capital account. Those drawings will be shown in the partner's current account. Only four transactions will appear: opening balance, further capital introduced, capital withdrawn and closing balance. That's it. You are not going to show any other transaction in the partner's capital account. That means drawings, interest on drawings, share in losses, salary, remuneration, commission, interest on capital, share in profits, any other transaction affecting the partner will be shown in the partner's current account only. Which account? Current. So for this, in this method you will have two accounts. Same partner, partner's capital account and partner's current account. So what will you show in capital account? Buy balance brought down. Opening capital. Buy cash or bank account. FC, football club. Further capital. Two drawings. What is this? Capital withdrawn. Not drawings against profits. If it is drawings against profit, you will debit it to partner's current account. Two balance carried on. That's it. Over. You will have nothing else which will show in the partner's capital account. Drawings against profits. You will debit which account? Partner's current account. Interest on drawings. Where will you show? Partner's current account. P&L appropriation account. Share in losses. Debited to partner's current account. Salary, remuneration, commission. Credited to partner's current account. Interest on capital. Credited to partner's current account. P&L appropriation. Share in profits. Credited to partner's current account. So apart from these adjustments, all other adjustments will be done only in the partner's current account. Partner's current account may show debit or credit balance. If debits are more than the credits, that means partner becomes a debtor. If credits are more than debits, then partner is a creditor. So partner's current account may either show debit balance or credit balance. If a partner's current account is showing debit balance, that means he is a debtor to the firm. If his account is showing a credit balance, that means he is a creditor to the firm. Is it clear? Are you able to understand? So under fixed capital method, please tell me how many accounts are going to be maintained? Two accounts. Partner's capital account and partner's current account. Under fluctuating capital method account, how many accounts are maintained? Only one account. What is the account called as? Partner's capital account only. Is it clear? Now open your book. We will solve some problems now. Please give me a book, somebody. Give me a textbook. Come to page number 8.6.